Okay, this is an example of a closing process problem, and instead of asking you to start from the very beginning, it actually asks you to start from about step 3. So let's just talk about what those steps are in the closing process. First of all, what is the closing process? The closing process is what we do in accounting at the end of the period to get the temporary accounts balances back to zero. The temporary accounts are going to be your revenues, expenses, and drawing. So those are the accounts that we want to start back at zero so that we can keep up with what happens in those for just one period of time. So we have to dump all the balances out of there. And here's how we do it. First, we close revenues to income summary. And when we say close, what we mean is that we are going to look in the revenue account, and the revenue will have a credit balance. To get that balance to zero, we're going to debit it, and then we'll put the other side, which will be a credit to income summary. So that's what we mean by close revenues to income summary. Then we will close expenses to income summary. So we'll do the same method. This time an expense has a normal debit balance, so to get rid of that, we will credit it. The other side will then be a debit to income summary. Next, we're going to close the account that we've been putting both of our revenues and expenses to, close income summary to capital. So at this point in time, income summary has your revenues and your expenses in it, which nets to your net income. So in essence, we are dumping net income to capital. And then step 4 says to close drawing to capital. Okay, so drawing has a debit balance, so we'll credit it to get rid of that balance, and then we'll debit it to capital, which will in essence reduce our capital, which is what drawing does. All right, let's look at what they've given us here. They have told us that after all revenue and expense accounts have been closed, okay, so they've done step 1 and step 2 for us, right? Then income summary has a debit of $315,000, so I would need to look at my T accounts to do this. So I recommend that you do the same thing, draw out some T accounts when you're working these problems. And a credit of $449,500. At the same time, capital has a credit balance of $750,000, that's our beginning balance that never gets closed. And drawing has a balance of $40,000. You need to know, because they don't tell you, that drawing has a normal debit balance. Alright, I want some commas though, so we'll put that right there. Alright, so they have already closed revenues and expenses. So let's figure out which of these was our revenue and which was our expenses. If revenues has a normal credit balance and we have to debit it to get rid of it, therefore we would credit it, which means that the credit side of income summary are our revenues or our fees earned. Okay, so that means that if expenses have a normal debit balance, we would credit those to get rid of it and therefore would debit income summary. So that would be our expenses. So this means in essence that we right now have a net income in this account of the difference. So let's look and see what that amount would be. Okay, right now we have a credit balance of $134,500. Read step 3. It says close income summary to capital. If we want to close this account, we have to get rid of this balance. In order to get rid of this balance, we have to debit it, the opposite, to get rid of it. And it says to close it to capital. So therefore, capital needs to be a credit. We debited income summary, so we're going to have to credit capital for $134,500. Alright, that gets rid of close income summary to capital, so that's our first entry. So the entry that we would write down right here would be to debit income summary of $134,500 and to credit capital, you would write Fay Barnes Capital for $134,500. Alright, now we're on to step number 4, close drawing to capital. To get rid of the drawing balance, we need to credit it. And then we would debit capital, which is going to reduce our balance, which is what happens when we have drawing, so that's right. Okay, so that journal entry looks like a debit to capital of $40,000. Remember, we want to put our debits first. And then our credit would be to our drawing account, and that would be $40,000. Alright, then the last question here asks us, what is our ending balance in capital? Well, our ending balance in capital is going to be the net of all these. So we add up our credits and we subtract out our debits and we put it on the side that's the largest, which luckily for us is going to be a credit, which is good because that means it's a positive number because it has a normal credit balance. And our ending capital number is $844,500. I want you to notice that this is the same thing as if we would have made a statement of owner's equity. Statement of owner's equity would have said beginning capital equals $750,000, and then you would add net income, which would have been in income summary 134.5 because that's our revenues minus expenses, less drawing, which would have been 40,000, gets us to our ending capital number. So that would be the net of all these, which would be 844.5. So notice that the closing process actually gets us to the point that we already knew from our statement of owner's equity. So we write out the statement of owner's equity, that's our financial statement, and then we update our accounts to reflect that new ending capital balance.